I read your report. This is your 2023 outlook, and you believe that when it comes, at least to the markets, we're close to bottoming out. So bad news priced in now?
That's what we believe. Now, we have to temper that with expectations of a recession coming next year. The economic data is fairly clear in that with respect to an inverted yield curve, with declines in housing that you mentioned, higher inflation, all of the typical signs that precede a recession are present. Yet we have to ask ourselves, how much of that has already been factored into the current market environment? And we would argue, I would say 70 to 100% of it could already be in the market. And in fact, we may have seen the low point for the US equity market, Canadian equity market, and others around the world in October. And so we are a little bit more optimistic from the market perspective, as well as not only equities, but fixed income into 2023, even with the headwinds of a recession in front of us.
So what is the market telling you then, Philip, in terms of a recession? Is it pricing in a mild one or something a little bit more severe? And what do you believe?
Well, it really depends market by market. If you look at valuations in Canada, in Europe, and in the emerging markets, we would argue that valuations are consistent with what you would see during the bottom of a recessionary process. And so that would lead us to believe that in these areas of the world, we are fully priced in with respect to economic risk. In the United States, valuation is still a little bit higher than would be typically normal for a recession. But that's not to say that it's expensive. The US equity market isn't expensive. We would just say that it's not reflecting the same type of trough valuations during a recession that we would see, for example, 2009 or 2002. So the upside in the US might be a little bit more muted next year as opposed to international equities.
Okay. And when you talk about valuations, what kind of numbers are we looking at?
Well, I like to use trailing earnings right now only because the analysts are still a little bit too optimistic in their forward earnings expectations. When we look at that, the US is trading about 19 times trailing earnings. Canada is trading about 13. International equity markets overall are about 12 to 13 times, and the emerging markets are at 11.
Oh,
when you
wow.
look at Canada, exactly.
Yeah.
You have the emerging markets that are trading at a deep discount relative to where the US equity market is. And that leads to this more optimistic view, international versus US.
Okay. So when you're looking at a diversified portfolio, for those viewers that are watching, it might be a good time to get some exposure into those emerging markets. Phil, would you say that it's a stock pickers market? And I ask that because it was not too long ago, and there was a lot of talk that value stocks were where you want to be. I'm wondering if that's shifting now to growth stocks.
Well, I don't think so yet, because in order to shift to growth stocks, you need growth. And what we know going into a recession is that growth is going to be scarce. So I do think that when you describe it as a stock pickers market, I think you're spot on. I think you want to be very selective with what you're buying. You want to be aware of not just the valuation, but what you're getting out of the company itself. So I don't think it's just pure value without any type of sustainable profit growth out of a company. But yes, less growth, more value. But I also would say that is an asset allocators market. So what we've seen in the past year and a half is that correlations for equity markets and fixed income markets were trending at one, meaning everything was moving in the same direction. But I think into 2023, you're going to see a lot more deviation of performance across asset classes as well as geographies.
Okay. Yeah, and that's an important point. We only have 30 seconds to the commercial break because I was going to ask you about bonds. They've been down as well. So you could see that divergence. Is that what you're expecting now?
Exactly. I mean, it was a terrible year for bonds because interest rates shot up as much as they did that no one had expected. But where yields are today sets forth a more optimistic outlook for bond returns, not only in 2023, but the next number of years.
Okay. We'll take a quick commercial break. Lots more to unpack. Stay with us.